Ramnik Sehgal, Chairman and Managing Director at Ceigall India, joining us. Now, of course, numbers, but also order wins coming through. Ramnik, talk to us about how Q3 has gone by in terms of execution, what's in store, where Q4 is concerned, and how does full year FY26 look?
Good morning. First of all, thank you for having me over. So, we've been always guiding our investors that we will be growing at the rate of 10 to 15%. But you've seen our quarter three results. Our revenue has grown by almost 19.3%. And our order book is robust. You can see we already have an order book for next 3.5 years. And we have already quoted projects worth 35,000 crore, 33,000 crore in fact. And that too in different 5-6 verticals. So we are not dependent on one vertical. We are not dependent on one geography. We are in about 13 states now. We have 11 verticals. So order book has never been a challenge for Ceigall.
Right. Ramnik, the other thing I wanted to also understand was that you received this LOA worth about 1,700 crore rupees, right? Help us understand, given that it's a large ticket project, what the execution timelines are, what's going to be the revenue recognition profile and margin expectations.
So this is one of the very good large project in MP, where we have to put a solar plant as well as a battery storage with it. So the timeline for this project would be about 2 years from the PPA. We have received the LOA. We are waiting for the PPA to happen. Of course, it'll happen in a few months. And once it is done, we are looking forward to execute it ASAP. Our USP of the Ceigall is completing projects before time. And we really want to deliver this project before time.
Okay. On the debt side, Ramnik, and we've spoken about this in the past, where you suggested that you are trying to resolve it through an InvIT kind of structure. How long does that take, in your opinion, to kind of hive off your debt and hive off the fixed assets that you sit on, which should basically aid you in your execution, right? Because order book is not a problem at all. It's just about execution.
So let me clarify the debt part. First of all, at company level, our debt equity ratio is one of the best in the industry. That's 0.28. At the console level, the debt, that's the safest debt, which is against the annuities which we have to get from the NHI. So we yesterday announced that we have already sold one project. With that, close to 236 crore of the debt will go. We are already in discussions to sell another 2 HAM. So total debt against all 3 HAMs would be around 730 odd crores. So this debt will go once these projects are sold. We have already sold one. Yesterday we have announced where we are going to get 177 crores as equity. 236 crore debt will be taken by the same company. Now, for the next 2 HAMs, we have already got the pre-COD of Bathinda Dabali. And we're already in discussion and negotiation to sell that. And third one is also in the pipeline. So we are targeting to close all 3 HAMs before the second quarter of the next year.
And therefore, should that significantly improve the kind of revenue clip at which you grow?
So 100%. So, our revenue is very clear because you can see the order book we already have. And the good thing is the HAM has already started. Because the circle of the HAM is once you get the project, in 45 days, you have to make an SPV. Then 150 days, you have to do a financial closure. So right now, only 3 HAMs are left where financial closure is already done. We're targeting all 3 should start before 31st March. And these 3, after starting these 3, almost 4,000 crore more execution under HAM projects will be there. So revenue will never be a challenge for Ceigall going next 3-4 years. And as I said before, we have already quoted for 30,000 worth of contracts till today. So those new projects will also come and some revenue from those projects will all come.
Ramnik, the other thing is, given that renewables is now a meaningful part of the order book, tell me what the revenue mix is evolving like for the next 2 to 3 years between roads, renewables, metros, and T&D.
So right now, the renewable and T&D is close to 30%. And going forward, sorry, I'm correcting, it's 19%. Going forward, we want to go steady and slow. We want to grow from 19 to maybe 25%. Because now what has happened is in highway, there are a lot of bidding happening. So a lot of contracts are there and the large contracts. And we are in the right spot there because we have available network. more the net worth you have, you can back more projects. So, I mean, as I said before, order book is not a problem. Mix of these verticals is not a problem. But yes, we want to grow slowly and gradually in these fields.
So, Ramnik, there's visibility. Your order book is at 13,000 crore. Your top line is at 3,600 crore odd, trailing 12 months. When I'm looking at the number, 3,000 crore FY25. Excuse me. What's the kind of growth clip that one can expect over the next 2 to 3 years? Give us a sense of that, because there's very clear visibility.
So, first of all, our order book right now is 16,373 crores. We have bagged few contracts last month also. And we bagged we were L1 in one of the very large project in Bihar, which is for 2,160 crores. LO is yet to be received. And going forward, we always guide our investors that we will be trying to achieve 10 to 15%. But the revenue visibility is great in next year. And we always want to be a little conservative and want to achieve more.
And the 14-15% kind of margin that you've always traditionally clocked, is that a sustainable number for you? Because we've seen that for some infra companies, they're willing to do business at slightly lower margins. I'm trying to understand how you're clocking the delta, because you're largely doing the same projects as the others.
So at EPC level, we always guide that we should be at 11.5 to 12.5%. For other income, which is a royalty income, bonus income, or income made from the FDRs, or like we've just sold a ham, we'll have a good bunch of coming profit from this ham. So that will add it in other income. With all this mix, it will be around 14 to 15%. But EPC margin will be 11.5 to 12.5%.
Okay, Ramnik, great to have you on the show today. Thank you so much for your time.
Thank you so much. Pleasure's all mine. Thank you.
Okay, that's the word coming in from Ceigall.